Okay, so we're going to continue on with the ITIP, individually tailored investment portfolios. And I want to review in context what we're doing here and what I believe are the keys to success of this approach. So we believe that we're in the process of demonstrating things that haven't been done before in a way that's scientific, a scientific approach to dealing with uncertainty, where judgments about the future are elicited rather than relying on data about the past. So what was done up to now, people typically look at past data and they project out the future. I'll mention how that's done. We're going to use judgments based primarily on secondary research of 7 to 10 analysts published in Seeking Alpha. The judgments will be elicited with pairwise comparisons, as you've done before, processed in an eigenvector computation to reduce the noise. A further reduction is we're going to have more than one person evaluate eventually. This is the wisdom of crowds approach. And so we're going to derive probability distributions for each stock or each alternative that's a candidate for a portfolio. We'll perform Monte Carlo simulations, and we're going to combine various alternatives in different forms, ratios, and so on, computing the expected return of the portfolio, the chance of losing more than any given amount, and the chance of achieving a gain more than any prescribed amount. So those are going to be our measures of effectiveness. And then a multi-objective approach that individuals can tailor the best portfolio for themselves. So we're going to work as a group to begin with, but at the end, you'll have an individually tailored portfolio. Now, in the process, I think you're learning a little bit about stocks, maybe that you didn't know much before. And at least you should remember, or at least you're learning that it really does pay to start planning for retirement at an early age. And don't wait until you're 40 or 50 years old. It's really hard to catch up. So I mentioned that Einstein's favorite formula was compound interest. And basically, that's what happens when you invest early on. So these, I think, are the keys to success. What came before this? I may have told this background story before, but I'll tell it again. Up until the 1950s, well, back in 1929, there was a stock market crash. You probably heard about that. And following that crash, hardly anybody invested in the stock market because it was just too risky. And so what people did is they put their money under the mattress. They did anything they could, but they never invested in stocks. In 1950 or so, Harry Markowitz, and here's some videos. There's a whole playlist of videos here.
Harry, thank you very much for joining. Pleasure and my honor to be here with Dr. Harry Markowitz, 1990 Nobel Prize in Economics winner and the father of modern portfolio theory. Harry, thank you very much for joining me today.
Thank you for having me.
I want to start off by taking you back to the early 1950s and tell me about your first investment decision.
When I wrote my article, my 1952 article, I had never invested. I was a student I don't want to say I'm a poor student. I mean, I was a student without funds. And the first time I had the opportunity to invest was when I had joined the Rand Corporation in Santa Monica. They offered TIA versus CREF stocks versus bonds. And at that time, I look forward to telling this story. People have it wrong, have it right, but they don't have the right conclusion. At that time, I thought if the market goes up, the stock market goes up, and I'm completely out of it, then I'll look silly. And if it goes down and I'm 100% in it, I'll look silly. So I went 50-50. So I was at that time, minimizing maximum regret.
So I'm not going to play all this video of the others, but they're really interesting to hear how Nobel Prize winners went about the research to get their prizes. And his story was, he was looking for a dissertation topic, and he was waiting outside his advisor's office for his turn to go in, and somebody was sitting next to him, and they got a conversation. He said, "What do you do for a living?" He said, "I'm a stockbroker." So he's asked him about what that involved and so on, and he got interested in stocks, and he developed what's called modern portfolio theory. Now, up until then, as I said, people did not invest in stocks. It was just too risky. But when modern portfolio theory came out, it was from an academic. It had certain fundamental processes and rules, and it looked like it was a good thing. So people started to invest again, and their returns went up drastically. Compared to what? Compared to putting money under the mattress, compared to investing in a savings and loan. So it went up a lot, but didn't go up nearly as much as it could have. And we made some assumptions in developing modern portfolio theory, one of which is his definition of risk. We spoke about this earlier, I believe. He defined risk as volatility. More volatile, more risk. Well, it turns out that's not correct. And still, his theory helped people make a lot of money, even though that wasn't correct. I think we had a video from Warren Buffett to explain why volatility is not risk. So what we're doing a scientific definition of risk. We're doing everything scientifically, and according to that, I'm optimistic that in the long run, this will work out better than these theories. Now, how many theories are there? I think there are 8 or so Nobel Prize winners. Each one took the previous theory and said, I'm going to improve on it a little bit. Improve on it. And they kept improving on it. And the latest improvement really, it's not very difficult to understand. Latest improvement was, don't bother. Just go out and buy an index fund that doesn't cause very much overhead. Invest in an index fund. It's very simple to do. But I don't think that's as effective, and we can do better than that. Okay, so that's the background of what we're studying here. We're learning. One of the things we need to know is how do we handle uncertainty? Because that's basically what it is. If you knew what the future price of a stock is, you've got to make it, right? Well, we do that with probability distributions. That's the scientific way of doing it. Where these probability distributions come from? Well, not from data from the past, because that's looking backwards. We want to know what's going to happen in the future. So we gather information, and we're doing it through articles. So people did primary research. These people's articles you've been reading have spent a lot of time at it. They differ. They give you different opinions. And so we're putting that information together to help us determine probability distributions. These distributions have to reflect reality. So what is reality? Well, if you ever listen to some of the stock market TV shows like on CNBC, but today there's a big discussion of what do you think is going to be best in the future? Tech versus non-tech. What's going to go up more next year or the year, tech or non-tech?
Tech.
Well, they had two people on different sides. Who's going to be more profitable, Google or Microsoft? See, Google has made most of their money on search engine. Well, AI now is going to replace the search engines. So these discussions go back and forth. And so people make certain assumptions. Well, these probability distributions have to fit the assumptions. And that's what we're going to be doing. The first assumption we're going to make, which we're in the middle of now, is that we're going to have a normal economy. The next phase will have the assumption that we're going to have a recession. Well, when you hear analysts talk, one of the things that always comes up is, oh, I think we're going to have a recession next year, therefore I'm going to do this. And then somebody said just the opposite. I don't think we're going to have a recession. I think we're going to have a soft landing, whatever that means. So we take all this information, we put it in probability distributions, and then we come up with various portfolios that we might want to try out, and we simulate them. And then you can, based on the simulations, choose the portfolio that best meets your individual aspirations. Which means what? Well, at a young age, most people's aspirations are fairly similar, but as you get older, some people have more money than others. So some people have to have reserve. They might have taking care of somebody that needs a lot of medical attention. There are different needs. And so when you're young, the primary objective, long-term objective, the expected value is what you're trying to maximize. So one of the results of our analysis will be the expected value. In other words, on the average, which of these portfolios is going to give you a higher return for the next 5 years or 10 years or whatever. In addition to that, we'll have a measure of what's the likelihood of losing. So things can go down, especially if you have a recession. So we may want to say, I'll accept the portfolio with a slightly less or maybe a considerably less expected value, but I'll have a lot less chance of losing. And then the third aspect is I might need some money to go into a business. And so I'm looking for a short-term gain in order to do this. So I might trade off those two aspects for the ability to have a minimum, increase the chance of a high short-term gain. So there's three aspects to help us individualize the portfolios to our needs.